3 weeks in a row where December corn futures have settled above $4 and 3 in a row where November soybeans have been above $10.
Hi once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Always pleased to have you join us on these episodes. Make sure you like these videos, subscribe to the videos by clicking the bell icon down below. That way we can let you know when we post a new update. And be sure and share these videos with others as well as we continue to grow this podcast. Thanks to your help. Well, I am joined by Joe Camp of Comstock Investments. We're going to talk about the market action here at midweek, and it seemed like a lot of attention was kind of geared toward what the Fed was going to say. And just before we started recording this, the Fed did come out with their announcement. What was everybody waiting for? What was the final result?
The question was a quarter point or a half a point. It was ultimately the latter, the bigger half a percentage point cut that the Federal Reserve decided on. That brings the top end of the federal fund rate down to 5%. It's the first cut that we've had of its kind since 2020, since early that year as the pandemic was starting up. We eventually moved rates back down to zero. Then in 2022, they started rising again up until where they were just before today. And finally, a move in the other direction. That was well telegraphed. This was the first, though, outcome is half a point reduction. Now would be the press conference. And as we speak, so does Chair Jerome Powell about the future rate cuts potentially. And this is one of what could have been just a couple of outcomes, half a point or quarter point. In this case, it's half a point reduction and probably trying to walk the line of still being somewhat hawkish and not wanting to spook investors about the possibility of inflation rearing up again. We know that's important for the agricultural commodities. There's a target on our backs here because of high inflation of the past that maybe in some instances has been wrongly attributed to grain and livestock commodities themselves. But you have this in focus here with the Fed decision today. We have it still in focus with the election coming up. Ultimately, though, the reaction pretty well positive as it could be, a little bit of a bounce for the grains and livestock in those minutes leading up until their close. Now that the Fed's talking, the stocks are up, the dollar index is down, crude oil's bouncing a bit. Ultimately, for now, a friendly recipe. We'll see, though, about how investors feel as the chair talks.
Do you think that euphoria may just kind of evaporate, though, after a few hours?
It could be, because you do have a large crowd left disappointed because of how we were so split heading into today about what to expect between the 25 or the 50 basis point reduction. You looked at the odds implied by the Fed funds rate futures just hours leading into this afternoon's decision, and they were almost still split 50-50. They did edge just slightly more towards the half a point reduction that we got ultimately. But that leaves a big crowd then that is saying, I thought it was going to be a quarter of a point. I thought it should be a quarter of a point. Now we've got a half a point. We're too aggressive. Maybe we're too late. They're too worried about the economy. That's what could pump the brakes on the enthusiasm here, is if we get to thinking, well, is the aggressive rate cut because we've got these central bankers overly concerned about the jobs market, for example, which they had added language here in the announcement about that there has been a slowdown noted in the employment numbers. So this is what we'll sift through not only the rest of this session, because the grains and livestock are closed. We've still got a few hours to go for the equities, for a lot of the energy market commodities and the currencies, again, which we're watching most closely as the dollar index right now tests that important $100 par mark.
Well, there was some concern before this Fed announcement that if they came out with a half of a point decline in the basis reduction there, I should say, that would maybe reinflate the inflation situation. Do you think that's a real possibility or not? It seems like the market doesn't think so now.
I think it's an absolute real possibility that we're going to be concerned with, already still dealing with inflation that's not all the way down to what the Fed's general targets are, say that so-called 2% rate. We've been running well enough above that, even closer towards 3% for these numbers, whether it's consumer prices or producer prices. whatever measurement. And so inflation already is still an issue here and could become a bigger one. Again, I'd have some worry about the grains and livestock having that target because of how they can be fingered as to their links with food prices overall. But it would feel to me like corn, soybeans, wheat futures, even cattle and hog futures have a lot of room to catch up as commodity prices are concerned before they would get back to levels that say that grocery prices, for example, have to continue to go higher because we know about how sticky those prices were. And then more concerning would still be the outside food and energy type inflation numbers, like for housing costs, for example, that we've got to keep an eye on going forward more than I would say I've got a concern for the grains and livestock. But we'll see how it unfolds here. Again, not only in the immediate reaction to this interest rate decision, but now into the lead up of our election in November and on into 2025, of course.
Well, you kind of touched on it a little bit ago, and I guess I was wondering if the ag commodity markets are even going to care. Are they just going to shrug it off, like just keep on schlepping down the road here? I mean, now they have to worry about harvest, the weather scenario, and how the production is going to compare with USDA estimates. Seems to be a wide variety of opinion remaining on that regard. So all in all, is that going to have much to do you think, for the next couple of weeks with the grain or livestock or not?
Eventually it should, when we circle back to take stock of where these outside markets ended up. And that includes the equities and the general sentiment about the economy. We know we've talked about the link between the stock market and the cattle here these last several weeks. But we think about in a bigger way crude oil and where it's headed, and it's linked to our feelings about consumer demand and the global economy as well. And then back to the dollar index, as important as this is, we haven't poked below 100 on the index level since briefly last year. Before that, it was 2020 and 2021 when that was in the 90s, that dollar index, and we had much better export demand. It was that last sort of transition actually from 2020 that I'm thinking a lot about lately, because we actually had, even with bigger crops, a return of big demand, including from China. We're bringing that up again because it's an election year and we're thinking about China and tariffs and all of the ongoing trade spats here and there with China. But to the point, there is this possible transition to thinking, how are we going to use these crops now? And the dollar goes a long way in giving us that direction.
Well, let's talk about the corn and soybeans technically. When you look at the daily charts here, I mean, it's been a slow grind higher, like, for example, on the corn. I guess it would be true on the soybeans too, but they were unable to take out the highs yet that were made about 3 weeks ago. That still seems to be an overhead resistance point. I mean, I know we're talking about small windows of movement here, but is that still going to be stiff resistance, do you think, to the market?
There are going to be points of resistance that include these recent highs, in part because you're talking about, for one, these long-standing longs in the market that are underwater and getting back to levels where they've seen just briefly before and deciding to cut these losses. That includes carryover of the old crop hedges and some old crop sales that are still possibly going to be hitting the market before we get even bigger into the new crop harvest. And that comes into play as well when you talk about whether it be different resistant points or psychologically important levels, like up at 4.25 or 4.50 for nearby corn futures, up to 10.50 or $11 certainly for soybeans. And these are going to be points at which we think the selling will be more active, and there's got to be waves of tests from the long side, namely from continued speculative buying, before we could eventually get past that. So those levels are key. To flip it around to being more positive, though, it would just be simply that, all right, it's been 3 weeks in a row up. We have 3 weeks in a row where December corn futures have settled above $4, and 3 in a row where November soybeans have been above $10. Chicago wheat, Kansas City cleanly above $5. We also have different areas of support now that set the range, and give us the potential for what could be being marked out as a broader turnaround, that potential harvest low.
Want more? Sign up today for our premium content. You'll receive our reports twice a day, plus every morning, an in-depth market analysis with Eric Relf. Every afternoon, you'll receive our daily podcast with Marlin Bohling. The first month is only $1.
Seems like on our premium service that we have, it seems like they're talking more and more about the dry start to the planting season in Brazil, for example. What can you tell us about that without giving away the whole thing here?
Well, that explained it today. The preview by Eric Ralph coming in on the morning report. Our subscribers, myself including, looking at those maps he's showing of us of drought in Brazil, as red as they are, and that coming into play and being talked about more and more as the Brazilian farmers head towards a new production season. Now, we'll watch weather. It's a La Nina season, so that comes into mind here. We continue to pull in research and talk about that on our morning updates. I know it's something that Matthew Cruz is talking a lot about in terms of his family farm down there and his boots on the ground information, the concern that we've got early on being a point of the market today, again, holding soybeans up when there was otherwise not a lot else going on, not a lot of new demand or anything like that. So that was key to set out the date. I thought today that Eric brought up those maps, and it's something we heard talked about for sure. Now, we'll note that monsoon season doesn't typically get going in full force until October, but we're at a point there. If it is further delayed and the outlook calls it for it to be, and if we have these issues with La Nina throughout the winter, all of a sudden it's a much different storyline relative to U.S. and our competitiveness against South America. So it's something we're putting a lot of focus on right now.
Yeah, we do have a lot of direct connections to Brazil production through Matthew and his family sources, and they're well established there. So yeah, we'll try and keep everybody posted in that regard. You know, I'm looking at the wheat, and it had kind of a tough day. Did I see where they actually increased estimates for Russian production?
You do have kind of the flip. Some downgrades again for France and their export expectations, but not any further reductions like we were calling for weeks back on Russia. Instead, mostly higher numbers. There's some questions about government informed statistics right now from Russia and that size of the wheat crop. There's even been, as an aside, resurfacing these stories about stolen grain from Ukraine entering different markets like Turkey, etc. We know about last week some risk premium entering into the wheat because of Russia allegedly launching a missile against a ship loaded with Ukraine grain. We know about Ukraine's attacks into Russia, including in and around Moscow, and wondering whether or not Russia's back to here heading into the winter, having targets of food and energy infrastructure in Ukraine. So all of these moving parts, all of a sudden, wondering if ultimately it's not going to be the same source of pressure as it was these last 2 years, these huge Russian crops that have really swamped the export market. There's better signs of life when you count the smaller French crop and the rising prices there at times lately. So even with a setback here for wheat today, wheat was the best performer last week. It also, again, joined corn and soybeans on having those 3 up weeks in a row. So some back and fill ultimately unchanged today, waiting for some fresh input now on that market.
So the livestock markets today closed about the time that we had the announcement from the Fed. They should have had just a few minutes to react right before the closing bell there, but all in all, the way I look at the closes here, I mean, it was kind of positive, but it seemed to be kind of a yawner too.
You did have an immediate jump off the lows, but not a convincing all-out turnaround with, as evidence, the feeder cattle down yet on the settlements. Again, a late rebound as well for the live cattle, not all the way there for the nearby October. But positive still, because it was a positive reaction for the stock market, and that will continue to be the case. That we'll likely see the cattle generally mirror the sentiment. And it's a higher stock market that gives the speculators the confidence to potentially re-enter this cattle market or to quit liquidating their long positions like they had been when the stock market was acting nervous in days past. And not out of the woods yet. We got to finish the press conference. We got to see the follow-up here the rest of the week. But it was a positive thing, I would still call it, this report for cattle and for hogs too, because of the simple fact that the dollar index was as lower as it was. We think a lot about the pork exports on their way again towards record levels again this year. All things goes well. And this is a reminder of why to be bullish about ag exports if that dollar is going to continue to slide.
It seems like the cattle charts are kind of in no man's land right now, and we do have a cattle on feed report coming up, right?
We do on Friday already again. It was the last cattle on feed report last month that surprised with bearish placements being higher than anticipated, yet the following Monday, again, why we call it the cattle on feed report, down at the start, but then up from there. Ultimately, we look at these numbers, relatively speaking, yes, placements and the total on feed count might be up from a year ago, but you're seeing that those absolute numbers are still historically low, and it's going to take time, everybody knows, to rebuild this herd. Still slow signs of that occurring at this point, and that's what is, again, friendly for the cattle as long as you have again, these outside market worries at bay.
All right. And it seems like already some of the euphoria is kind of fading a little bit on the Dow as we record this. So, yeah, it could be kind of a choppy time here. Can't wait to see how we open up tomorrow in tomorrow's trade after we have a night to sleep on it. Thanks again for all the information, Joe. Good to hear from you again. Joe Camp of Comstock Investments with us. That'll do it for this episode. For producer Brian Hendrickson, I'm Marlin Bohling. We'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.